Welcome to tonight's webinar. For those that don't know me, my name's Craig Banning. I'm the CEO of Navwealth and the host for tonight's webinar on wealth transition and helping your family step into property ownership. So I'm very excited about this webinar, and the reason why is over the last 3 years, I've seen so many clients, all of us here at Navwealth have seen so many clients that are stressed about helping their children or their children, in fact, buying a family home. I don't think we've seen a period like this probably, well, certainly not in my lifetime, maybe not for 2 or 3 generations, where it's been so hard for the young people of today to buy properties. So tonight, we put this together tonight to basically help, I guess, a lot of our clients with how they're going to manage and assist their children. And it's sort of not surprising how hard it is. We've got the biggest cost of living crisis in probably 2 or 3 generations. We're seeing property prices now that are just gobsmackingly huge. I mean, there's not a week go by I'm just not constantly stunned at what a particular property might be worth. And in fact, I was reminded a few days ago by my mother. I asked her about when she bought her first home. My mum and dad bought their first home, and even I was like, wow. It was in 1968. They were 24 years of age. I wasn't born till 1970, so that was a couple of years before I was born. And they bought a modest home on the northern beaches at Mona Vale. They paid $16,000 for the property. And the part that really got to me was their loan was $8,000. So they had $9,000 of cash and $8,000 of a loan. And I said to Mum, what were you and Dad earning then? And she said, oh, well, your father was earning $60 a week and I was earning $40 a week. So we had a total family income of $100 a week. And then Mum said, but don't worry, we lived off your dad's $60 and we saved my $40. And I just thought, my God, imagine trying to live off $60 a week. And that just shows you what inflation does over a long period of time. And the fact that they could save a deposit of $9,000 with a loan of $8,000. I mean, it's, you can see why we've got this dilemma today, because that same house today, unrenovated house at Mona Vale, would be about $2.2 million. So how could anyone 24 years of age buy a $2.2 million property, just an average home in the suburbs at Mona Vale? And I guess that's why we're here tonight. What's really important for everyone online, I'm sure you know this, but I will just quickly say it, it's incredibly important to get individual advice. This is what we call general advice. It's general in nature. It's impossible to give advice to anyone in a group setting like this. So please see the professionals you need, such as a mortgage broker, financial planner, accountant, lawyer, and property experts before making any decisions. In terms of introductions, I'm going to start off by introducing Sally. Sally is the CEO and founder of Sandcastle Finance and is also the director in our joint venture with Sandcastle Finance. And we have a joint venture with Sally because we got to the point at Navwealth where we found it impossible to hire a highly skilled mortgage broker, and we decided to do a joint venture with Sally and her team over there at Sandcastle Finance. So that's why we work together. Welcome, Sally. And the next page, very exciting, our special guest for tonight. Here are our special guests, Camilla. Thank you so much for joining us tonight and sharing your story with us. Linnea, thank you also for sharing your story. And of course, Jami, who also works at Navwealth, thank you for sharing your story. I think it's really great that we've got 3 people that are willing to share some real life stories that are actually done or doing what we're about to talk about tonight. So I thank you very much for joining us. So let's get into it. First slide, we've got a fair bit of material to go through. So the very first slide we're going to start to talk about is with Sally, and we're going to talk about gifting money. So these are the things we're going to cover in today's agenda. We're going to talk about how can you help your family get into property, gifting money, how you do security, going on title? What are all the different ways of doing that? The government schemes, we're going to cover that. We're going to talk about the life case studies as I've talked about. And at the very end, we're going to do our Q&A. We can answer all your questions at the very end. We're doing it at the end just because there's so many slides to get through, and sometimes you can have sound problems on webinars if you start having lots of people talking. Okay, let's get into the topics of tonight. So let's start off with Sally.
There we go. Sorry, thank you. Okay, so it was just interesting hearing what you were saying about I just did a quick calculation just in terms of what your parents' income was and what the income was in regards to loan to value ratio, and that will probably just kick that off. Because basically in today's market, we're looking at, say, 4.5 times people's income for serviceability, and we'll get a bit more into serviceability. But when you talked about your parents' income, it was only 2 times. So therefore, and then you can look at how if they could save that amount of money, which is half the value of the property, which makes it really a lot easier back then as compared to today's terms. And then we're looking at the pandemic, just for example, banks were lending up to 7 times people's income. So you can see probably a little bit just in terms of income, just in today's market, of how difficult it is now to actually A, save, and then B, get a loan. So just in terms of what we're looking at in the Australian market right now, I just did a bit of research on what CoreLogic is basically saying, that Australian home values have actually risen 35% since the pandemic. So that is quite massive. And, and we're hearing about and that's arisen for a number of reasons. I think, we hear about the massive migration the Australian government has let into Australia over the last couple of years. There's like 600,000 people, which is unprecedented as well. We've got the building crisis that's going on. So even though that, just to give you an idea, in 2013, we're probably about the same approvals where we are today. So that's 11 years ago. Even though the approval level is about the same as it was 10 years ago, we're not getting the building to start because developers and builders cannot see the value in actually starting to build. So there's this massive undersupply of property in the market, which is causing, obviously, supply and demand. It all comes back to that. And so we're not building enough. We've got record levels of migration. We've got the inflation, and then the cost of living. So what we're also seeing is that kids are staying at home longer because they can't afford to move out. And so there's all these joint households. So it's, there just becomes really the solution has been, and we hear it from the banks, that the actually third biggest bank in Australia right now is the Bank of Mum and Dad. So so, even though we might say CBA is number 1, Westpac's number 2, but the Bank of Mum and Dad, and it is a real thing that we are the number 3rd bank in Australia. And that's going to probably continue or probably become number 1, I would say. And there's this massive generational wealth. So I guess today's webinar is just solutions on how we can help our kids get into the market, because I don't personally see the prices coming down. As I said, we've seen a 35% rise in the property values just in the last 4 years. Even if it stays the same, it's not going to go backwards, in my opinion, too much. So, and obviously we hear daily about the cost of living and just the lack of supply, which is also pushing prices up.
Okay, that's true. I so agree with that. So now let's talk about gifting money to children and the different ways I think that you're seeing people do that, Sally.
Yeah, so what we're seeing is parents, as I said, when we talk about the Bank of Mum and Dad, we're seeing either parents gifting their children a large deposit so they can get into the market. So one of the biggest things is, obviously, with the increased cost of living, is that we're not being able to save as much as we were. And just back to Craig's example of the parents, if their income is $100 a week, they're able to save a 50% deposit. I don't know how long that took them, but in today's terms, if we were to save a 50% deposit in a Sydney market where the average house price is, say, just over $1 million, that's $500,000. It's going to take a long time to do that.
Yeah.
So what we are seeing is kids getting inheritances a bit earlier, like if their grandparents, for example, have passed away, we're sort of skipping that generation, and so it's going to the children. So that helps them get the deposit into the market. We're also seeing parents help with, say, stamp duty, because that's another massive cost right now, even if you've been able to save enough money. So even if you look at $1 million property and you've been able to save $200,000, you're still going to have that extra stamp duty to get into the market. And then we look at where we live on the Northern Beaches, for example. You're not going to get a lot for your money for $800 to $1 million, unfortunately, anymore as well. So we do have the first homeowner schemes, and everyone continually says to me, we can't buy much on the Northern Beaches. Like, even though they've got the stamp duty concessions up to, say, $800,000, what can you get for that? So there are opportunities if you look for it, and where you can get into the market, but you still need at least $40,000 to get into the market. So that's where we're seeing parents help out by, first of all, number one thing is gifting money. And I guess the advantages of that are the kids don't have to pay for the deposit. They may have the income to sustain a loan, but it is like, even if they have the income, it is very hard to save the loan. And if we even just look at the last 4 years, it's almost impossible to say, like, if the property's increasing 35% in 4 years, it's very hard to save that money, as opposed to if the parents are able to give them the money to actually at least put their foot in the market, so they can actually, at least from today, get the uplift in the value of the property for later on down the line, because that's a real big advantage of being able to get into market now, because who knows what's going to happen. But as we've probably seen in the Sydney market, prices don't really go backwards in a big way.
Yeah, that's for sure. And have you seen any cases or disadvantages of parents lending money? Because it is so common now. I'm sure there are cases where people have done it incorrectly, for example.
Well, the only thing is, if kids aren't used to saving money and they're used to going out and spending money, I think the one big disadvantage of our children at the moment is, back in the day, probably when your parents were saving money, they might have had the jars, for example. They saw cash. We only have plastic these days.
Yeah.
And you don't really understand the value of money so much, I don't believe, when you're just going, tapping here and tapping there, because it is really hard to budget, I think, if you're not taking, like, if you don't actually consciously think about what you're spending. Yeah. So I think that is the big disadvantage of not actually kids just being given money and not actually understanding the value of it and continue their lifestyle. Because I think if you want to get into property, you're going to have to make some sacrifices. And we heard that from our last live thing we did with a girl we had who was 26, who managed to buy 2 properties in like 5 years. Main reason was that because she was very frugal with her money, she was able to say no to holidays and able to say no to buying clothes and doing what all of your friends are doing. And I think that is a really thing that a lot of our children don't do so much. And I do think that plastic is a big problem.
Yeah, I agree. Saying no is hard for everyone, including us. No doubt about it. So let's then talk about guarantor and security, because that's another way that we see parents getting involved. Do you want to talk about that? What are the main advantages?
Well, the main advantages, again, like, there's a couple of advantages. Well, first of all, the children aren't having to save the deposit. So the way guarantor security works, and I guess we go back to even just look at the last 4 years of what's happened in the market. A lot of parents now have, in Sydney, they have a lot of equity. Like, even if you look about the increase in equity they've got over the last 4 years, it's, say, 30%. And as I said before, it's really hard to save that amount of money. So if you've got $1 million property and it's risen up to 1.3 in 4 years, that's $300,000. You're not going to be able to save that amount of money, in my opinion, by continuing your lifestyle. So That's where parents are coming in to being able to offer that property as security. I think there is a slide up here. This is basically a slide of where we're looking at guarantor security. So there's different ways to do it. In particular, I like the way this is done because we have what we call a limited guarantee. So what it is in this example, the kids, John and Jane, they want to purchase $1 million home, and they have two options to do this. So they either have to save the $245,000, so that's $200,000 cash to avoid the mortgage insurance. So that's mortgage insurance is something that the banks get people to pay if you don't have 20% deposit. So it's a safeguard for the banks and it's insurance for the banks. And there's only two insurers in Australia. And if I ever come back in another life, I'd be a mortgage insurer because I don't think it's ever been claimed on, to be honest. It's a lot of money. It's up to say 4% of the loan amount. So if you don't have the 20% deposit, you're sort of looking at about a $40,000 loan on top of your loan, just in case you default on your loan, and that goes to a mortgage insurer. So the way to avoid that is parents can offer that $200,000 in their own property if they have that, and the children still borrow that amount of money, but it enables them to get into the market faster. So it means that they don't have to save that $200,000. It works really well if people have the borrowing capacity to do that. So as we talk about the cost of living, and it seems that, if you as is human nature, your income increases and then therefore your spending increases. So it's not necessarily, unless you're very diligent, you're going to save it. So a lot of people have the capacity to borrow the money, but they may not have the savings. And it's to avoid mortgage insurance, parents can offer up their security. Now, people that have done that in the Sydney market in the last 4 years have only been able, parents have actually only been on the loan for a couple of years because of the increase in the property prices. So I always recommend that you do have if you are looking to do that with your children, you maybe have a 2-year strategy and then you revisit it in 2 years. And what that enables, we focus on trying to pay off the 20% deposit loan. So we can actually do for example, a principal and interest loan just on the 20%. So we just get rid of that loan and the parents can be released in up to, as soon as a year if the price has increased and they've put a lot of money away, or, generally 2 to 3 years. In the last 5 years, they've been able to come off the loan. I don't know how the market's going to perform in the next 5 years, but that's something to discuss. And it's always worth, and it's the advantages of doing that is that kids can get into the market sooner rather than later and, hopefully enjoy some equity growth.
Beautiful. Yeah, that's fantastic. I mean, as you say, it helps the children get into the market faster. And if you got in 3 to 4 years ago, you'd be very happy today. That's for sure. So let's now then talk about the disadvantages of I guess doing the guarantor, and I guess the disadvantages are for the parents more than the children yet.
So, I mean, the way that it works is generally if the child isn't paying back the mortgage, they have 9 months to pay it back. They have 9 months till the bank's going to come after them. So what would happen is if the loan for their property, if the bank's forced to sell their loan, this is probably the worst scenario, and the bank don't recover the full amount of the loan, that's when they can come off to the parents' limited guarantee. The way that we can try and avoid that is because the loan's going to be in the kids' names, they can actually still pay that loan off in the worst case scenario if they don't have the income. There are ways to obviously mitigate that risk, such as you can get loan insurance just in case. But yeah, that is probably the biggest risk to the parents. Then we're looking at, if they, for example, wanted to sell their house and downsize, for example, they would probably need to release their guarantee in that regard. But there are, again, options to do that. We can have money in a term deposit and we can do a security substitution. The risk is basically, I guess, again, people not understanding the kids not understanding the cost of money and like what it actually, how's it actually helping them, and them still thinking they don't have to probably save money. So that's the biggest risk, I think, in terms of just the kids not paying the mortgage and going into default.
Yeah, and like I've not seen this work poorly yet, because we make sure that the clients doing it with their adult children know these risks and plan for these risks and plan for downsize, all these various things. So we've not had a problem with this, have we? Because we do it well with our clients. The only time I've ever seen security guarantors go badly is with businesses. I'm a bit against children that go to mum and dad and say, "Oh, I want to buy a franchise for $1 million. Can we use your houses as security?" That I would be dead against.
Yeah.
but not for property. So great. So that's basically the disadvantages. So now let's moving on to another very common strategy in relation to going on title with children, Sally.
So I was actually, as I mentioned before, I was just actually at a funeral, and we're actually talking about this topic because I was trying to get them to come along. But it was, a lot of parents think it's more worthwhile for them to go on title. So they do have that safeguard because they think it's probably a safer option for them. So they might feel like if they've got, the parents have ownership in the property, they have a bit more control, rather than if they're just guarantor, they're not actually on the title of the new property, just in that example. So, and we do see, what I have seen a lot in the last couple of years, especially on the beaches, I've seen family members who say parents have got quite a large block of land, and I've seen the kids want to get into the market. So what they've done is they've built a granny flat, for example. So I've seen this in a couple of cases where the kids have paid for the granny flat. They've gone on title for a certain percentage of the parents. And we do have some really good options for that, for being able to do that. And that is property shares, with what it's called is a product called property share, which enables each party to have either, for example, if the parents have no debt, they can still have no debt and be on a loan, and vice versa. The kids might have all the debt, but the parents have to still have some say in that debt. So until it's all sort of paid off, there are definitely options like that we do have available. And yeah, again, the advantages are if improved serviceability, because that is tough these days. So it helps if parents are still working and the kids want to get into a property, so all the income goes towards that. And so the loan repayments are shared. The main disadvantages are if you want to do something further than that. So it's, once you are joint on title, you're generally joint and severally liable for the debt moving forward. So for example, and we'll hear about the case study with Linnea and Camilla a bit later on, but going forward, it does affect your serviceability, because generally most banks, and there are exceptions to this, will see that whole debt as joint and severally liable. So it means that if you're going to borrow money, even though you're only responsible for half the debt, most banks will make sure you're responsible for the whole debt for the next loan, if that makes sense.
Yeah. So again, it's another thing, isn't it, Sally, that there's got to be a good communication between all parties so that everyone understands what they're doing and that everyone understands their obligations. I'm sure you agree with that.
Correct.
But it can work well. It can work really, really well. So now let's talk about serviceability. This is probably the area of borrowing money today that there's not a week go by I'm not surprised about serviceability, Sally. I'm not a mortgage broker, of course. I'm a financial advisor, but I'm constantly stunned how banks these days are more concerned on serviceability, that is income and being able to service a loan, than assets. And we had a case recently where a client with $12 million of assets was struggling to borrow $1 million. And the client's going, "But Craig, what are you talking about? I'm worth $12 million. Why can't I borrow $1 million?" And I think, Sally, you deal with this every day. This frustrates me like nothing else.
Well, yeah, I know. We have this discussion. Look, basically the banks look at, and I call it the 3 S's. and its serviceability is number one. And what serviceability is simply the income you receive versus your expenses. Now, it doesn't matter if, and I get this all the time, that I've got a credit card, I don't use it. However, it's got a $40,000 limit. Just in that example, the banks don't care that you don't use it. They see the limit of $40,000 and they immediately go, well, 4% of that $40,000 is $1,600. So that's your expense for the month.
Yeah.
That's just one example.
Even if you don't use it, yeah.
Even if you pay it off every month. Now, there was a time before the Royal Commission that if you could provide 3 months of statements to show you paid off your credit card every month, they would ignore it. That's not the case anymore.
Yeah.
Same with mortgage offsets and mortgages. We see a lot of people that like to have, they say, oh, I have paid off my mortgage. But they actually, when they say they've paid off their mortgage, it means I've got my title deeds. I don't owe any debt, no other banks on the title. So I still see that all the time where people have the assumption that because they've paid it off, they haven't got their title deeds because, again, the banks want money to get your title deeds back. So a lot of people go, oh, I can't be bothered. I'm just going to leave it there. But the bank will still see that as, even if it was at $1 million limit, for example, they'll still use that in serviceability. So it doesn't matter what is the balance, it's the limit that counts.
Yeah, very, very stressful. So then if we come back to children, often these days that young adults are getting trust distributions from parents and families. We see this quite a fair bit from family trusts. So what are the advantages, I guess, of this, Sally, of people having trust distributions to improve serviceability?
Well, we are limited to a few banks that will actually accept this. That's number one. Not all banks will accept trust distributions, especially it's from their parents, and then they generally want to see 2 years of history. So if you've received trust distributions from the family trust for the last 2 years, we have a limited number of banks that will use that in serviceability. Now, the reason that parents do that to their children is that they're reducing their taxable income. So most times you want to have to make sure that you're not wanting to borrow any more money, because then the bank will say, you can't sort of say, you're going to distribute your funds to the kids, so you're going to pay less tax. And then if you want to borrow the money, you can't then take that money back because it's already in the kids' sort of tax returns, even though it's not to theirs. So, I mean, again, servicing is one of the toughest issues, and that's the first thing we have to get through. And there's, we see people every day. I mean, Camilla works with me, and that's what we basically do on a daily basis is servicing. And it's, a lot of people just don't service the loans that they got 4 years ago.
Yeah, let alone more debt.
Yes.
They don't service the existing loans. Yeah.
Yeah, and the main reason is because, as I mentioned at the very beginning, banks were sort of, doing the serviceability at 5%, because even we were getting loans at 2%. We're now servicing loans at 9%.
Oh, that's
9.5%.
So that's really good. Even though the loan interest might be 6, the bank's assuming it's 9 for the point of serviceability. Yeah. Great point. And what about disadvantages with trust? You might have covered a couple of these before, but.
Well, again, yes, it's a risk of overextending yourself and not being actually able to repay that money. If, we are quite conservative in Australia by having that 3% buffer, which, does help. And that's why I get probably on a daily basis, I'm sure Camilla does as well. It's like, well, I can afford to pay my current loan. Why can't I move to another bank? It's because the main reason is that whatever you've got borrowed now is the bank's saying, well, if you can't borrow it at 9%, we're not going to lend you any more money. So I guess the banks are conservative, but the disadvantage if you're not getting those trust distributions. I mean, trust distributions don't literally go into your bank account. They're generally a tax effective strategy. So it's not actually going into the kids' bank accounts. So I guess that's the biggest disadvantage.
Yeah, I mean, not regularly, but it is supposed to end up in the children's bank account at some point in time. Of course, we remind our clients all the time that if you distribute money to your children, it is their money, even if it sits in the trust. It's very important these days. So let's talk about government schemes, because this is something that I find personally hard to keep track of. what are the options for parents and their adult children?
Okay, so currently I haven't seen what's actually coming out next financial year, but as of last year, the 1st of July, this financial year, July 24th, July 23, there was 35,000 spots available for what they called the first time guarantee, which was the 5% deposit, but they have a cap on it all. And each state has a little bit of a different scheme, but the basis is what the government would guarantee 15% of, because they saw one of the problems is that kids can't save enough money. So they said, we'll ensure, instead of paying mortgage insurance, we will basically guarantee the 15%. So all of these schemes have caps on it. And so that's why we see at the moment there are still a lot of places available. The first 2 years they had the scheme during COVID when rates were quite low, they only issued about 10,000 of these spots and they all went by the January, and we've still got a lot of spots available because of I believe it's the caps. So if you think about, there's a cap of up to 900,000 for property prices, but there's also an income cap. So what that means is that you can't, if you earn over $125,000 last financial year as a single person, you can't apply for the scheme. But if there was two of you going into this scheme, you can't earn more than 200,000. Now, if we go back to the sort of rough figures of 4.5 times income, that's basically where you're at. You can't go over that. So
Yeah. So I get what you're saying earlier, like on the northern beaches where we all live, that's actually quite hard to meet the criteria, isn't it? In terms of finding a property, under $1 million and then having the income. I mean, it's quite a tough criteria for the wonderful place we live in.
Yes, it is. The other thing they opened up was last year was they said you could, because they saw there's an issue. So they did actually say we can now buy these, you can go into this scheme with siblings and friends, because before last year it was only with partners or single people.
Yeah.
So that's sort of given an opportunity. We've done this with a few siblings and friends as opposed to just de facto relationships. And then we've got the no stamp duty up to $800,000, and it's discounted up to $1 million. Now, these figures are just in Sydney, whereas if you go outside of Sydney into regional places, the cap is $750 to $650, depending on where you are, for the property price you can buy into there. The income cap's still the same, but the property prices are still, outside capital cities, it's a lot lower.
Like everything, it's complicated. My gosh.
Yeah.
And what about limitations? Do you see any limitations for families that are considering these types of schemes?
No, I think if you can take advantage of it, take advantage of it. But a lot of not, and as I say, like that with the limits, with all the spots that are still available, it just shows you that it's hard. The criteria is a bit hard. They're going to have to make it a bit easier, in my view.
So again, it's like seek advice, right? Because clearly the income's important, who's doing it's important, location of the property is important. And as for building a new home, not sure how you could possibly build a new home for these limits, but somewhere in the world, somewhere in Australia you could build, I guess.
Yeah, not in Sydney.
Okay, we're now moving to our live case studies. Yes, this is, I'm so happy about this session. And if we move on to our first case study, when I saw that today, I thought, well, it's very obvious you're mother and daughter, no doubt about that. So thank you. And thank you, Linnea, for sharing your story with us, because I think for everyone tonight who's got adult children just like you, it just makes it so much more real. So I'm really keen to hear about your experiences. And I think my knowledge is that you got a gift from your grandparents. So tell us a bit about how you entered the property market with your parents.
Yeah, so I was lucky to receive a gift from grandparents in 2018, I believe it was. Yeah. And that basically helped go towards a deposit to an apartment. So, yeah, as it says, me and my parents went on title together, and that was able to basically be my portion of the deposit and then going with my parents as well, and yeah, helped me get into the property market.
Oh, that's just so fantastic. I mean, it must feel amazing to be in the
Yeah,
property
definitely
market,
very
does it?
lucky. Yes.
Because I notice when I talk to my children, they're 25 and 23, like, and their peers, they've nearly given up. When I sort of sit around the table with a bunch of people in their early 20s, that they literally have nearly given up. It's just really sad
Yeah.
to hear that sort of despair that they might have. So I guess in your case, I'm keen to understand a bit about, if it's all right, where you live now and the fact you rent it out. Tell us a bit about that story.
Yeah, so we live on Northern Beaches as well, and I think Linnea she's Northern Beaches girls and hopes that she can live here in the future at some stage. So instead of buying something somewhere else, we had some equity as well, me and Linnea's dad. So we decided that we go in to be able to buy a unit here close to Manly. We went in and bought on title as well. So we put in equal amount of deposit into the property. That allowed us to actually get into a investment property for us on Northern Beaches as well. So we, to make sure that Linnea as a first home buyer could use the stamp duty discount, she has got 50% on title, because as a first home buyer, as long as they have 50% of the title, they can use that stamp duty discount. And me and Steve went in with 25% each on title.
Yeah, wow, that's just so exciting. What a great strategy for everyone. I mean,
Yes.
I'm struggling to think of why this isn't a great strategy. And obviously, when some of the grants are involved, like first home grant, it's really important to move into the property. The intention, to move into the property. I just want to raise this because this is something that's a bit close to home for me. Many years ago now, I saw one of my clients' children who got that grant and didn't move into the property, and of course somehow got I'm not sure how it came about, but basically they got the government grant, they should have moved in, they didn't move in, and basically they were charged with fraud, and this wonderful young lady lost her job. We shouldn't say what the job was, but it was in the world of law. So it was a really terribly sad scenario because they didn't follow the rules. And I think that's something that we're all very big on, is following the rules on these schemes.
Yeah.
And obviously you moved out for a while and got to live in your property, which would have been nice.
Yeah, for sure. Yeah, it's definitely a cool experience. But I think then with COVID, I had to move back home. But yeah, for the time being, it was a cool experience. And my plan is to move back in next year.
Because of capital, because as she was originally her own occupied, it's her home. So as long as she moved back now within 6 years, she will not have to pay capital gains the day she sells the property. For us, it's always going to be an investment property. Was our share is investment, and it will be when we sell. So we of course have to pay capital gains. But for Linnea, she doesn't have to, even if she moved out now for a number of years, as long as she moves back.
Yeah, that is just one of the most wonderful tax strategies we have in Australia on our principal place of residence. And yeah, for Linnea, it's great. She won't pay tax when she sells her property down the track, and mum and dad will be saying, don't sell, because you won't want to pay tax.
Yeah. And another thing which has been part of our strategy, when we started, Linnea only worked part-time. She was still in end of high school. So she could not service half of the loan herself.
Yeah.
So we had to we borrowed all the funds together with our income as well to service, as Sally talked about, for the serviceability. Now Linnea works full-time, and so we are now in the process of changing it to a property share, which allows us to only have half the debt, because on paper now Linnea has a debt of the total amount of the loan, and on the paper we have the debt of the total amount of the loan. But now we're going to split that up, which allows us maybe to go into next investment property, and Linnea maybe to apply for a credit card if she necessarily needs that in the future, etc.
Oh, that's great. I mean, it's such a great strategy. I mean, can you remember, because it's a while ago, can you remember the government schemes that you looked into and which ones you could and couldn't use in your situation? Can you remember that? It's a while ago now.
Yeah, no, it was, so the stamp duty, she got full advantage of that because it was within that limit when we bought it. So Linnea didn't have to pay any stamp duty. We had to pay stamp duty on our share. For the guarantee of the 5% deposit, we didn't need that, as we had we had 20% deposit, or we had 25% deposit of the property, but we would not have been able to use that as we were not first home buyers. So,
Yeah.
but the stamp duty discount we got, so for Linnea as for her first home.
Oh, that's great. Well, thank you so much. Is there anything else you wanted to add about your wonderful strategy and how well it's worked? And anything else
No, only that there's lots of moving things to think about. So it's good to really plan it out before you go ahead and buy something together with your kid. Do talk through it and sit down and plan for everything, so we know exactly what will be the best advantage for everyone.
Yeah, I think we'd all agree with that. I mean, this is not something that you decide on a Sunday night and buy a property the next day. There's a lot of planning that needs to be done, and with professionals, to make sure that everyone understands what's going on and plans for all the various things that could go wrong, with people losing jobs and all those various types of things. And now there's other government grants. I can see I've got a message here on the chat about the superannuation and saving for property deposits through superannuation. Have you seen much of that yet, Sally and Camilla? People using their superannuation for paying deposits and things?
No, I haven't, but I constantly, when I speak to lots of people who are this generation, who's now planning for the first purchase and they're not quite there. And that's something I'd strongly encourage. Put in that extra money, because that's actually a really great help. You get free money from the government.
Yeah, well, when I was talking to my mother, she told me that back in her day, when I asked her, how'd you get that much cash when you're earning $100 a week? And she was telling me about it. Her employer, which was a government employer, she'd put money in and the employer would match it, and then you could withdraw it tax-free at the end. So a bit of a similar story, which I actually didn't know about that scheme until my mother told me about it, but that helped them into their deposits. So I think this current scheme we have with superannuation perhaps is a little similar. So thank you very much for sharing your story again. I'm sure everyone that's listening is really writing notes furiously and going to have a very interesting family conversation next time they catch up with their children. So thank you very much. Let's go to case study 2, which is Jami, and obviously that's Sally's daughter, Jami. And so we roped Jami into sharing her story with Dave, her partner. And I think this is another take on another way of doing things. So again, thank you, Jami, for sharing your story. Can you tell us about your journey and what's happened to this point?
Yeah, sure. So I apologize. Dave, my partner, couldn't be here today, so I will share his story on his behalf as well. Basically, we've been together for a few years and we're sick of living at home and we wanted to move out. We're fortunate enough that both our parents are mortgage brokers, so we had that conversation pretty early on with them and said, look, what's the best way we can do this? And they said, there's no way you're renting. You're not going to go move out and rent in the beaches because it's going to be too expensive and then you're never going to get into the property market. So they basically just said, look, we'll allow for you to stay at home for a little bit longer. You guys can save up your money and then we'll help you get into the property market. Obviously, our ideal goal is to live on the beaches, just like Linnea. It's very expensive. We can't afford it. We didn't actually service for too much if we were going to live in it ourselves. So then we came to the conclusion that we were going to buy an investment property. And then just through working with our parents and then building a team behind us, we've kind of come up with a strategy where we're now looking at Newcastle and Western Sydney because we've value land over an apartment if we're going to be spending that amount of money, and then hopefully leverage that down the track to then get ourselves in the property market in the Northern Beaches.
Oh, that's great. And when you say a team, you've built up a team, perhaps explain to everyone who the Jami Prowse team is.
So yeah, as I said, we're very fortunate that we have 2 mortgage brokers in the family, and then also have my dad, who's an accountant. So very fortunate to have him. And I obviously work at Navwealth, so I'm surrounded by financial advisors constantly. So very fortunate enough in the people that I know, and then people that we've actually been introduced to. We've been introduced to a town planner, we've been introduced to buyer's agents, and they've really helped us kind of strategize our ultimate goal of getting into the property market on the Northern Beaches, and how we can do that and how we can do it as fast as we can. And yeah, that's my team.
Oh, that's great. Yeah, I mean, we are big believers at Navwealth in buyer's agents. We have a number of buyer's agents we use, and often even our really experienced property purchasing clients can't end up getting a property and need to get a buyer's agent to help them actually secure one. It's just that damn hard to secure a property in some locations. You mentioned, Jami, Western Sydney and Newcastle. Do you want to just share, because obviously you love the Northern Beaches. Why did you start thinking about outside of the Northern Beaches?
Yeah, so look, we, after talking to buyer's agents and kind of giving them our brief of wanting to get into the Northern Beaches market down the track, we realized that we're going to have to do this by having land. There's no way that you could have an apartment and then capitalize that in 5 years and get enough money built up to then buy something that's worth $1.5 to $2 million down here. So we've realized that if we got a place with lots of land, we can then add value to it by either putting a granny flat onto it, looking at subdivisions, all that kind of fun stuff that we're looking at. So we realized that we can only really get a place like that in Newcastle and Western Sydney while staying close to the Sydney market. We've also been looking at Brisbane and Melbourne. However, we just didn't like the fact that if something went wrong, we couldn't just jump on a plane and be there in 2 hours, where in Western Sydney and Newcastle, you can jump in the car and you can be there within 2 hours to do anything that you need to do. So that's kind of why we've narrowed it down to those places.
Yeah, look, that's great. And that's one of the things that frustrates us a bit in Sydney, because, you know, the rule book of property pretty much is that land goes up in value, the building goes down in value. So pretty much anyone in property will tell you it's about land to get the most appreciation. Therefore, houses generally perform better than apartments. But it's very hard in Sydney because of the value of even a modest home in Sydney. And we've got a question on the chat, which we'll come back to in the end. So thank you for that great question, which is a bit similar to that. So I want to remind everyone online, if you add to the chat, we will cover these questions at the end. Now, Jami, I know you just love and adore living with your parents, and they love having you live there at home. Tell us a bit about how that's helped you.
Yeah, that's helped me a lot, because obviously we've been able to save up our money. We're not going out and paying that $500 a week in rent, which is what it is generally in the Northern Beaches. We're paying mum and dad a little bit of that money, but not nearly as much. So it's allowed for us to save up that money. I mean, my partner Dave and I both have quite big HECS debts. So it has allowed for Dave more so than me to save up all his money to pay off his HECS. And then it's also allowed for us to save up that money. So then when we do get that investment property, we can put that straight into an offset account.
Yeah, great. I mean, what's really amazingly wonderful about your strategy, Jami, is you and Dave really are sort of leveraging both your families, which is really fantastic. I mean, you know, obviously your parents, Jami, you know, Sally's on the line. So obviously Sally and Simon have talked to Dave's parents. You've all got together and said, how are we going to help Jami and Dave into a property, which is fantastic. I'm sure the next thing I'll be talking about, Jami, is when you're getting married, probably after you buy a house. But there you go. Sounds like everyone's planning things really well for you. And so now you're in the process, and what are the next steps for you now? Where you're at in your journey?
Yeah, so we've been pre-approved. We've been putting offers in on houses. We've unfortunately been pipped right at the last minute on quite a few places. We do have a very specific
criteria that we're looking for in houses. So there's not many houses that we've been coming across where we go, okay, yep, this is it. It's taken a lot of back and forth with parents. I know they're probably sick of our phone calls every second or third day, every weekend, driving back from Newcastle. Oh, what do you think of this? But yeah, like the property will come. We're still looking. There's quite a few in our radar. Obviously, working with that town planner around zoning and stuff as well has really helped us narrow it down. And obviously, when the right one comes along, it'll come along. But yeah.
Yeah, that's awesome. And I must say, you know, Jami, I've heard each week about the number of properties you and Dave have looked at, and it's absolutely admirable how much research you're doing. I don't know if you know how many you've looked at now, but it's a lot, isn't it?
It's 10 a weekend for like the last 3 months or something.
Yeah,
So it's a lot.
So it's huge. Yeah, well done. So that's great. Thank you so much again, Jami, for sharing your story and letting me have a few jokes with you. Thank you very much. And so now, just sort of to wrap up, I guess, Sally, to come back to you. What's your thoughts now in terms of how we wrap up and the different ways parents can help their children? We've been through that. Have you got any other thoughts you wanted to raise?
Steve's just brought up a point. Unfortunately, now we're just about HECS debt. Jami did mention that, and that is one thing that lenders do now take into serviceability, which they didn't previously do. I mean, Linnea was probably at school when she didn't have a HECS debt, but it is affecting kids' serviceability. So just for an example, what we've done a few cases lately is that if parents are offering up security guarantor or even a larger deposit, we're actually encouraging them to pay off the HECS debt, because it actually does help with serviceability, and it does help with their take-home pay as well. Like, it's actually quite scary, this HECS debt now. So that's one thing. And one thing to get started, I would suggest probably just do a budget, really, like get the kids to do a budget, work out it, even if like we're talking about trust distributions and additional income and rental income, but doing actually an analysis of, like, in the case of if you're buying a unit, what actually is the cost per month for things like strata, rates. It's really important to know what the cash flow looks like, I believe. I'll probably go back to Camilla. Like, Camilla might have a bit more input in that as well.
No, I agree fully that you have to they have to understand, because living at home, quite often they are not aware of all the costs, which we are very much aware of ourselves, because we have been paying the water, the electricity, and everything else for them. So it is, of course, super important to sit down and go through, is this possible? It's not only the loan which is going to get paid, it's also the strata, and rate, electricity, and all these things. But we have done the same thing with the Linnea now these years. When she's been moving back home, she can live at home if she pays off a substantial amount of her HECS every month. So that is our gift to her, is she can stay at home, and then she has to make sure that she pays down her HECS.
Yeah, I'm sure she loves living at home too, Camilla. I can see that. Yeah.
Yeah,
so
she's starting to reach the same as Jami. She's quite keen to leave.
So I guess as a bit of a recap, you know, we've gone through a lot tonight, and I think as I've been sitting here listening, there's so much to think about on all of these strategies, that depending on which ones people do. And I think for a lot of parents in their 50s, 60s, or even 70s, you know, they may have only bought a few homes in their lifetime. They may not have investment properties. So there's quite a lot to know. And I think from my perspective, it's just shown me tonight how, to use Jami's words, you do need the team around you of advisors. But if I just come back to you, Sally, have you got any thoughts about how to start? You know, if someone's on this call going, okay, this weekend we've got to get the kids around, how do you think they should start the process?
With the kids? I mean,
Yeah.
well, the first thing really is the kids need to probably understand what their serviceability is, and what And as we talked about what that equates to in monthly payments, I think even Jami's serviceability was quite a lot higher than she was more comfortable with paying back, because I think that it's really important to understand what the monthly cash flow looks like. So I think that is important. And then understanding the differences in terms of like different loan structures, whether you're going to be paying, if you are going to be doing an investment, if you're going to keep staying at home, if you're going to be living there, just all the different costs that are involved. I think, but we always start with serviceability. We start with the 3 S's. It's serviceability, security, and strength of character, which basically, as I've told you, is like income and expenses. Then we want to know what security we do have, whether we're going to be using mum and dad's property, whether they're doing a deposit for them, whether we are going to be using a first homeowner scheme. So that's the security piece. And then just make sure that you do know what is on your credit file. It is very important that you do know that you don't go and get zip pay. You don't go and get all these afterpays, because that all goes on your credit file and that all goes to your strength of character. And banks don't like, and we now have this thing called open banking. So basically what that means is the banks know everything that you do. They know when you've applied for a credit card. They know when you've applied for a personal loan. They know when you've gone shopping and you've decided you want to have that dress and you're going to go and pay afterpay. They know all that. So it's really important to know what is on your credit file, and it all goes towards a bank application. And you don't want to apply for credit really unnecessarily, because it goes on your credit card file for up to 7 years.
Yeah, that's a really good tip.
Can
So
I add
let's
something?
sure,
So
please,
I
Camilla.
think it's great when the thoughts pops up with your children. Come and have a talk. Just book in half an hour with Sally or me and go through, so we can explain as well to both of you, so you know at this stage what serviceability you have. And even if you're not going to buy now, so then we can set up a plan for you, so how you can get in maybe in 2 years. So you know what goals you're getting towards. So we're always happy to help out with that.
That's a great first step. That was I was going to suggest. Call you two. That's exactly what I was going to say. So let's, due to time, let's get into Q&A, I think now, just because of time pressures. I've got a couple of questions here on the chat. They're really good. So I'm just going to read them out first, then we'll turn the mics on and people can ask questions. But this first one I really like, and I'll just read it to you. It says, we've just bought an investment property on the Central Coast for $800,000. It's on 760 square meters, so it could be subdivided later and have a duplex on it. The house is tenanted now, could get rent of $650. How might we go about getting a loan to build, then to sell one and keep one for the kids? Do you see any issues with this idea or suggestions? I'll just start off by saying there's a whole myriad of things. First of all, that is fantastic. I love that strategy, but there's a whole myriad of things to think about. Tax, definitely, and also lending. Sally or Camilla, have you got any thoughts on the lending side for that question?
Camilla, do you want to?
Well, it's serviceability. If it's tenant, I don't know if you have a loan today on it or what the equity is.
Yeah, so it's hard to know the details we've got, isn't it? So it might, let's assume they've got a loan now, whatever size, who knows, and then they want to borrow more to build. So that's going to be, can they borrow that much? It'll be probably a construction loan, won't it? So they're a whole nother beast, construction loans.
It doesn't necessarily need to be a construction loan. Some lenders actually let you lend up to 80% of the land value. So it will depend on how much you need to borrow to build on that and how much loan you have at the moment. So because sometimes you want to, if you can avoid a construction loan, it's a little bit easier if you just have a credit, which you can draw down to your own. But it's again, give us a call and we can look at all the details and do the calculations. But in principle, it sounds good. Good plan.
Yeah, no, I think it is too.
You can borrow. You will be probably able to borrow to help to build the next.
It's just come back on the chat that there's no loan. So in other words, the loan would be just for the construction. So again, serviceability loan to value ratio. Yeah, that's what it's really come down to. But I would suggest getting some tax advice as well, just to understand how that's going to work when you sell one, keep one, and everything else. Is a fair bit in that. The other question I've got here from Jenny is about estate planning. It talks about, should we consider updating our estate plan if we're going to support one of our daughters into her first home? We have discussed a simple agreement, but not sure if we should do something more. So I might just take that first, which is, if it's one of the most important things we talk a lot about in our financial planning meetings is, if you've got a number of children, it's always got to be fair. You know, if it's not a fair, if you don't help your children fairly, you'll end up with family problems. And that's a whole conversation in itself, because, you know, you might help a child now in 2024, and you might not help the other child till 2027. So you've got to make sure the child you're not going to help till 2027 understands that they're not being left out. So there's a whole bunch of discussions around that. And then if you do end up literally gifting money to a child, you may want to make some adjustments in your will, because what if you gave $500,000 to a child today and then unfortunately died the next day, and the assets were split equally, just say, keeping this really simple, between two children, then actually one child's got more of a help than the other child. So we always would take into account estate planning if large sums of money have been gifted to children. Thank you very much. It will be recorded and available, so we will be able to use this for people that weren't able to join us tonight, because we did have a lot of people say to us they couldn't join us tonight, but are desperately keen to get a hand on, get a grip of this. I'm sure we've helped not only people on this call tonight, but people that will listen to the recording. So thank you very much. Good night.
Thank you all.